As good capitalists, us risk takers are always trying to beat the market. That is why it is important for us to use every scrap of information we can find. But does having a lot of information help us in any way? Well, according to the efficient market hypothesis, the answer is no. You see, the efficient market hypothesis states that a securities price already reflects all the available information on the market. This is because if the information did not reflect the price, there would essentially be an arbitrage opportunity. And as we know, arbitrage opportunities are closed like that. So as every market speculator is using public information, there is no arbitrage opportunity, and hence the EMH holds in this logical fashion. What this also means is that it is futile to use public information in gaining above market returns, and that is probably the biggest implication of the EMH. Mainstream economics was first introduced to the efficient market hypothesis by Eugene Fama in the year 1970, and perhaps the most compelling evidence for the EMH comes from the CAPM model. Fama stated that according to the efficient market hypothesis, market prices would eventually reach an equilibrium. It has also been proven that the CAPM expected returns converges with long-run returns of an asset. And hence, the CAPM is essentially consistent with the EMH, which in some ways proves its factualness. Another argument for the EMH is that it is simply consistent with real life. For example, in real life, the vast majority of investors do not earn above market returns. The EMH provides an explanation as to why this is the case. The investors are all using the same source of information, and hence there is no arbitrage opportunity. So no one can make above market returns. EMH detractor Robert Shiller ironically also uses real life, but to point out contradictions of the EMH model. For example, if markets are always efficient and always reflect the true value of a stock, how come there are massive sudden price drops and price corrections? Shiller proposes that in these cases at least, volatility as well as the loss and gains were larger than what the public information made it out to be. Another argument against the EMH is that market efficiencies are simply everywhere if we know where to look. None is a better example than the ongoing pandemic, where there is evidence to suggest that the market had not responded to the data the way the EMH model states it will. You see, there is a massive demand for prediction markets, which all failed to predict the impact of COVID-19 ahead of the general public. Quite clearly, if the impact of the pandemic was accounted for in these market prices ahead of time, then there would not have been a massive price dive from February to March this year. The same argument was raised for the 1987 Black Monday market crash and the dot-com bubble burst in the years 2000. The EMH has been criticized for narrowing our perception of markets as an efficient and perfect system. COVID-19 will hopefully further academically challenge this perception and improve our understanding of markets. To summarize, the debate between Fama and Shiller ultimately hedges on the nature of investor decisions and market bubbles. The linchpin of Shiller's argument is that if the EMH was accurate, bubbles can be identified and investors would only make rational decisions. However, bubbles are only ever identified for certain after they burst, and investors are proven time and time again to be irrational. Fama in retort states that bubbles are never identified because we don't know how to define one. In my opinion, the EMH is correct in suggesting that information impacts market prices. But as Shiller points out, the returns or losses of an asset is typically much greater than what public information suggests. The efficient market hypothesis is critically flawed in this fashion, and it is important to keep our mind open for other possibilities.